Before we get started with today's show, I just want to take a couple minutes to talk about permissionless for the next conference presented by Blockworks. It's happening in June 24th to 26th in Brooklyn, New York, and it's all for the developers and builders in crypto. So if you're interested in really understanding how the nuts and bolts of the crypto industry are being built and you want to learn more, go ahead and get your ticket. I'm going to be there as well as with Quinn and the rest of the Forward Guidance gang. It's going to be a ton of fun. So use the code FG10 at checkout and you'll get 10% off your ticket. So really looking forward to seeing you there. Prices are going to be going up pretty quickly into the lead up of the event. It's only a couple months away. So be sure to act real quick there to get the best deal. All right, back to the show. All right, what's going on, everybody? Welcome back to another episode of Forward Guidance. And joining me today is repeat guest Bob Elliott of Unlimited Funds. Bob, great to have you back on the show. How's it going?
Thanks so much for having me. It's an exciting time in markets. This is the stuff we live for.
Yeah, and you can see it, and at least under the bags under my eyes, at least you're looking a little bit better than I feel like I am on camera. But man, it's been a tiring couple of weeks. It's high energy. It's a lot going on, a lot to get into. It's the macro Super Bowl these days.
You're not lying. It's definitely the Super Bowl. And fortunately, I've got this nice soft lighting that helps improve my complexion. So that's it's not for large amounts of sleep, particularly with a little one in the house. So
yeah. New kid, new ETF. Huge variance in markets. I'm sure you're a busy guy. Listen, I want to get in today to really diving deep into global capital flows, trade flows, and what are the big impacts of what we're all trying to digest here, and really get you to walk us through the sequence of, first off, just really understanding how we got to where we are today. So, over multiple decades now, we've obviously been living in this world of what is the U.S. dollar reserve currency and the sequential impacts due to that. And when we talk about this, we hear a lot of words of, the U.S. running a twin deficit, obviously like high fiscal deficits, high trade deficits, namely, goods deficits. And on the other side of that balance sheet is obviously the capital account side of things, and which is just a lot of dollars going out to the rest of the world. So I would love to really do a deep dive into this today and really start with just understanding how did we get to this point today where we have such large twin deficits? What have been the key drivers of that, especially with respect to this theme of the U.S. reserve currency and how that was one of the key drivers? So yeah, just walk us through, how did we get to where we are today?
Well, really, it's been kind of a 30 or 40-year process where the U.S. has increasingly borrowed from the rest of the world and received capital inflows, and that has helped finance essentially a relatively simple thing going on, which is that we're spending more than we're earning when it comes to our relationship with foreign countries. And I think in some ways it's important to divide that story into two key parts. The first part, which really started kind of, let's say, mid-90s and came up all the way until basically the global financial crisis, was primarily driven by that dynamic was primarily driven by particularly Asian reserve accumulators who engaged in a set of proactive policy to depress their currencies in order to stay competitive in the global market, to industrialize, China obviously being the most relevant of those. That process, and in order to keep their currencies depressed and their economies competitive, they recycled earnings that they had from trade into U.S. dollars, and particularly into U.S. treasuries and agencies and other assets. And that was, a big flow of capital in the U.S. And the consequence in the U.S. was, first of all, of course, we had the ability to spend more than we earned, meaning we got, more cheap stuff in particular into the U.S. But that capital flow also led to a depression in U.S. interest rates relative to what they would have been. And in many ways, that was, I think, probably one of the most important dynamics driving the housing bubble. Was that flood of capital that came into the U.S., that credit that essentially had to be distributed through the economy. At that time, we were running less significant fiscal deficits, so it wasn't really the government that was absorbing that through borrowing. It was really the private sector, and that drove a boom in mortgage borrowing, et cetera, and that created the housing bubble, and then of course the subsequent bust that occurred as that slowed. And so that's kind of really step one. And that really is what I'd call the dollar reserve currency story, as sort of is typically understood. I think post GFC, we've transitioned to a very different story, which is a story of U.S. exceptionalism. And that's important because the nature of the capital flows that have come into the U.S. post GFC look quite a bit different than they did pre GFC. In fact, most reserve accumulators have basically had flat holdings of bonds for a decade or more. So it's not really a reserve. It's not really the U.S. dollar as a reserve currency that's the big story here. Instead, most of those capital flows were betting on U.S. exceptionalism, and particularly post GFC. If you looked at the world and you said who responded to the GFC most aggressively and who had the best economic conditions coming out of the GFC, it really was the U.S., because the U.S. was most aggressive in addressing the economic challenges that were in place and stimulating the economy. And that was compounded by the fact that the Europeans had their debt crisis and had a malaise for an extended period of time as a function of that. And so capital flowed into the U.S. and into U.S. assets from the global private sector. So part of that was from traditional savers like insurance companies, pensions, et cetera, and part of that was from other players in the private sector. And it flowed not just into U.S. treasuries, but also significantly into U.S. stocks, and not just into U.S. stocks, but in particular into U.S. stocks on an unhedged basis, meaning people were taking the currency risk along with the equity risk. And that process really that started post GFC became long in the tooth post COVID, as again, the US responded to COVID most aggressively, came out of COVID with the strongest growth. Of course, there's other things here like structural productivity gains and stuff like that, AI, technology innovation, all of those things. I wouldn't downplay those things. I would just say they're part of the element compounding this. And that created essentially the final surge in capital, which allowed for an extremely large current account deficit, but also was incredibly supportive to U.S. asset prices. By the end of last year, U.S. financial assets were absorbing about 70% of every incremental dollar that went into global financial assets. And that is a function of that near 15-year post-GFC period of capital just flooding into the U.S., making that bet on U.S. exceptionalism.
There's been this narrative that this dynamic that's been going on for a couple of decades now, and as you characterize it, first off, it was the reserve accumulation trade, especially from Asian economies, and then now it's shifted into that dynamic. And you hear a lot about how this trend is unsustainable. Do you believe it's actually unsustainable? Because there's this idea that okay, we can't just let the current account deficit widen into infinity forever. There's eventually going to be a time where the chickens would come to roost, and we would have to quote unquote deal with this eventually. However, you will get into the potential impacts of what dealing with it actually looks like. But is this dynamic unsustainable?
Well, I think the basic question is whether asset prices and debt levels basically get pushed to a level that that can no longer be plausibly supported by projected incomes, right? That's the real question. And so I think when you're thinking about it, capital flow driven growth and foreign purchases of financial assets can persist for an extended period of time if it's paired with actual economic activity that is commensurate with those capital flows and asset pricing. And similarly, borrowing can occur, and you can have a buildup of borrowing for an extended period of time, no problem, as long as you plausibly can create the income necessary to service that debt over time. And I think the challenge that we have, that we're seeing, really the turn in the last 6 months or so, is that people are really starting to question, particularly foreigners are starting to question whether the U.S. can actually make good on all of that capital flow that has come in and bid up asset prices, U.S. asset prices. And that's really the question is, when you had a circumstance, and I was writing about this a fair amount last summer, where you looked at the projections that were happening in terms of US stocks or the AI trade, let's say. And it was basically suggesting that we were going to have something like a doubling of corporate margins over the course of a 10-year time frame to meet the expectations that were getting priced into those assets. You look at that and you say, I mean, could it happen? Of course, anything could happen. But like that seemed like a pretty implausible outcome that was going to happen. Similarly, you started to look at, I think foreigners in particular started to look at U.S. Government borrowing in particular, and basically said, not necessarily can the U.S. government make good on its debts. The U.S. government can make good on its debts, and anyone who says the U.S. government is going to default is a loony, right? Like that's just doomerish stuff. Because of course you can always print the money in order to service the debts. The real question is, are you going to get a good real return on your bonds over time? And particularly, are you going to get a good real return in your own currency on your bonds? And that's one which, again, also people started to raise questions about whether, at these debt levels and the incentives and prioritization of the U.S. government, is it going to make sense that you're going to get a good real return? And the thing that's so important about these sorts of dynamics, typical bubble dynamics, is it's not that capital flows have to fall to zero in order to create a change in price. The only thing that has to happen is capital flows have to go from being extreme to slightly less extreme in order to create negative price changes. And then often what that does, if you, for instance, look back at the US GFC, often that change from extraordinarily high capital flows to slightly lower capital flows or borrowing creates a negative price effect, which creates a self-reinforcing dynamic. And so we meaning the United States, is still getting, 65 cents of every dollar instead of 70 cents of every dollar. But just that shift and flow down can create a relatively meaningful price change. And that's exactly what we've seen. Effectively, whether you look at the currency or you look at US stocks relative to foreign stocks in local currency terms of those foreign investors, we've seen, a pretty significant shift in terms of price changes, 10, 20, 30%, which, when you're all in on, when those folks have been all in riding the Mag 7 train for 5 years, that's a pretty big shift in the opposite direction, a pretty big reversal.
What stablecoins did for the US dollar, Ondo is doing for stocks, bonds, and more. They're making real-world assets accessible on-chain, laying the foundation for the next wave of financial innovation. With tokenization, Ondo Finance is transforming how financial assets are owned and traded. Discover how Ondo is revolutionizing capital markets at ondo.finance. That's ondo.finance. Restrictions apply. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. So it sounds like what you're characterizing is that, when we talk about these dynamics and changes and flows, we're not talking about, questioning the sanctity of the US dollar reserve currency. We're not questioning the idea that they might default on their debt, or there might be a failed treasury auction or anything crazy like that. It's more so just, who's going to be the one who has to, take that P&L hit in a way, whether that's on, US treasury assets or US stocks and equities. But I have also heard this narrative out there that one of the key reasons that the US has been able to run this path for so long, this twin deficit path for so long, is because of what comes from being the reserve currency. And if you look at other countries, if they were running these same fundamentals, they would have run into issues, way further out into the past. But at the same time, those are also fiat, economies. They could have also printed debts and come out of this. So my main question is, what is that breaking point? And why is it that, if they can just print out of it, is it true that it's only because they're a twin deficit reserve currency that they've been able to sustain this? Or if they were just another random country that wasn't the reserve currency, would they have hit these sort of like, failed auction type dynamics that we're talking about?
The question in terms of what's driving the capital that's flowing into the U.S., I think it is lazy thinking to say, oh, they're just the reserve currency. Like, no, there's a reason why capital came into the United States over the last particularly the last 15 years in the post GFC period. It's because the U.S. was the strongest economy in the world, right? And that's totally, I should say, amongst the developed economies, it was the strongest economy because of the various policy actions that have been taken. You might say it was too stimulative in terms of the policy actions, and there's consequences of that. But certainly from a growth perspective, from an innovation perspective, the US was on top. And so it's not altogether unreasonable that you got fundamentally based capital flows that flowed into the US, whether it was chasing after higher stock returns or the fact that US yields were higher than much of the rest of the developed world. Right. The question is, when does that magnitude of capital flows become so extreme that it's pricing in something that is not reasonable relative to what's likely to occur? And it's one of these things where, if I remember correctly, the last time we talked, you asked me for a hot take and I said fuck valuations. And I think
Yes.
it's a good reminder, which is that though that sort of boom in capital flows, it in and of itself is positively self-reinforcing and can create, it essentially has a life of its own. The question is, when do you start to get moments where expectations are very high and where those expectations are likely to be disappointed? And that's when you start to get people just ask the question whether or not this is a good deal for them. And that's what creates the turn. And when we talked at, when I was looking at the beginning of the year, my beginning of the year outlook was curb your enthusiasm, because I looked at what was being priced in, for instance, the US equity market and growth expectations and stuff. And it looked like, euphoric expectations relative to an economy, the US economy, which is like moderately slowing, consistent with a late cycle environment. That looked like an expectations disappointment that was going to get set up. And that's basically what's happened, except it's been a bit more extreme than I would have guessed at the time, because the policies that have been prioritized by the new administration have been even more growth negative than I think most people expected at the beginning of the year. And so that's what creates the turn. This is not like a fundamental crisis of confidence in terms of the dollar as a reserve currency. The dollar is still the reserve currency. Nothing's going to change that. But that is not incongruous with the fact that there might be capital flows that have poured into the US that have made US assets too expensive relative to the reality that's likely to come.
All right, we're at the stage now where we have a huge current account deficit, and on the other side of that is this huge capital account surplus. And I'd love to just better understand the mechanics. So you mentioned the prioritization of policies that the Trump administration is pursuing. There's obviously a lot of different ways they're talking about it. We hear the tariff talk, we hear non-tariff barriers, we hear unfair currency, devaluations from Asian currencies, which you mentioned at the start of the show. When we consolidate all those different ideas, it seems like the priority is to narrow the current account deficit. So I would love to just understand the mechanics behind why does that lead to, on the other side of things, a narrowing of the capital account surplus. And, you mentioned some couple quick examples of, obviously, goods and stuff come into the US, dollars go out to the rest of the world. If that is going into, say, the manufacturer of foreign goods, and so now they're sitting on US dollars, paint a picture of how those mechanics works, of why is it that they put it into those dollars into treasuries? Why is it that they put it into equities? And why is it that if we assume this idea that the current account deficit will narrow, that leads to this also, narrowing of the capital account surplus, and why that leads to lower US asset prices?
If you look at the composition of the policies, the way I describe them is it's a suite of growth negative policies that are being pursued. And I think that's important because the particular motivations, some of which I think are being pursued for the reason that you're describing, which is closing, trying to take proactive steps to close the current account and really improve US overall trade dynamics in manufacturing. Some of it has nothing to do with that. It has to do with for instance, restricting immigration significantly, which in and of itself is just a negative growth policy. And so when you look at that, I think one of the things that often gets forgotten is like, how do large trade deficits close? Large trade deficits close through compressed demand, and demand compresses through slower growth. That's the way it works. If you go back to an emerging market economy and you look at, large emerging market, emerging market economies that have large financing needs that then have meaningful adjustments to their current accounts, the reason why it adjusts is not really to do with the currency, because because if a currency adjusts quickly, it takes as we're learning in the United States, it takes a long time for capacity for exports to pick up. The way current accounts compress is they compress through slower economic activity and a compression in demand. So what's happening here is, in some ways, the administration is engaging in some policies that are exogenously growth negative, as I said, like the immigration point, or they're proactively targeting policies that are intended to slow consumption. Right. The reason why you put in tariffs, essentially it's a consumption tax. Right. It just happens to be a consumption tax on a particular set of goods, but from the end consumer's perspective, it's just a consumption tax. And, fiscal consolidation, consumption taxes are very effective at reducing overall demand. And that's how you close the current account deficit. I think in some ways you want to think about these things as a intersecting set of dynamics, because at the same time, what's happening, so I should say that likely puts the U.S. on a path of having a reduced financing need in the future. The thing that's happening, though, is that the demand for U.S. assets, financial assets, is slowing faster than the required financing needs coming from the current account deficit here. And when I describe that, what I mean by that is the other consequence of having growth negative policies is those very high expectations are likely to be disappointed, right? Those expectations that we were going to have, 3% real growth in the United States in 2025, that's not likely to come to fruition given this policy mix. And so what's happening is that foreign investors are starting to pull their capital out of the U.S. to reflect as a function of that disappointment. Asset prices are starting to shift down, particularly in their currency terms. Very important to recognize, in their currency terms. It's not that bad in U.S. currency terms. It's considerably worse in their currency. And so they're starting to pull their capital back. And that pullback of capital is moving faster than the reduction in the financing needs that comes from the trade, from the current account improving as a result of slower growth. And the result of that is a weaker dollar, weaker asset prices, and weaker growth. That's the combination that we have right now, is that combination together. And to some extent, that's putting somewhat upward pressure on U.S. interest rates, which is really just downward pressure on U.S. bond prices, as a function of the fact that as the currency falls, people are looking for higher yield in their fixed rate assets in an environment where they're seeing the exchange rate fall on a regular basis, in order to be sort of net neutral from a foreign currency investor's perspective on getting a total return on those assets on an unhedged basis.
When we think about classic examples of these balance of payment crises, and obviously we're not in an outright crisis yet, but we're heading in that direction somewhat. So it's useful to think about when we think about classic, like emerging market style balance of payment crises, what happens is currency down, bond prices down, equity prices down, capital just getting out of there. When we use that as an analog for the US, which is a reserve currency, and a developed market, what of that framework is useful to compare in this situation?
The general dynamic of large reliance on foreign capital, which eventually gets disappointed for some reason and gets withdrawn, which creates downward pressure across the currency, the bonds, and the stocks, is very appropriate for what's going on. That's basically what's happened to some extent over the course of the last couple of years, or the last couple of weeks. It's not quite as extreme as a traditional acute emerging market crisis, but the dynamics are pretty similar in that way. I think the key difference between a traditional emerging market crisis, if you've studied them, and what we're seeing today in the U.S. is that because the U.S. has most of its debts denominated in U.S. dollars, the central bank, and I should also say, and because the U.S. is a large, diversified, domestically oriented economy, the central bank is typically going to respond to that set of dynamics by prioritizing domestic growth conditions rather than exchange rate stability. Now, remember the old adage, like you can have, exchange rate, you can pick your exchange rate level or you can pick your interest rates. Those, you get one of the two. Given that trade-off, when you're an emerging market central bank and most of the debt that you have is denominated in foreign currency, you have to prioritize exchange rate stability, because the only way, for instance, as a government, that you attract capital in order to pay off that foreign currency debt is by raising domestic income, right, through taxes and stuff like that, and transferring that to foreign currency and paying off the foreign currency debt. And so when your currency goes down, that directly inhibits your creditworthiness because your ability to generate income goes down as well. In the U.S. context, the dollar could be, DXY could be at 110, 90, it could be at 65, has no influence on how the U.S. government accumulates its revenue or how it pays off its debts. And so because of that, emerging market central banks will typically defend their currency aggressively at the expense of their domestic economic conditions in these sorts of environments.
Often by hiking, right?
By hiking interest rates, exactly. Yeah. By hiking interest rates, intervening, hiking interest rates, basically doing what they can to support the currency. In a large, domestically driven, diversified economy that has all its debts in domestic currency, the solution is to just let the currency go. What's it matter, right? And prioritize delivering monetary policy that's appropriate for domestic conditions. And I think importantly here, as part of that, is the large domestically oriented part of the economy as well, because that means that if the exchange rate falls, if the dollar falls, it basically has no impact on inflation. So let the thing fall, right? Why would you ever prioritize raising interest rates in a way that was, inconsistent with underlying economic priorities if your exchange rate has no impact on what's going on? Right? I mean, imports are a tiny percentage. They're basically all invoiced in dollars. There's basically no effect. The dollar can go up or down 10, 20, 30, 40%. It basically has no influence on your on U.S. landed prices because it's all quoted in dollars. It doesn't make any difference. So in that case, what the Fed will prioritize is they'll prioritize stimulating domestic economic conditions. And when I say that, what I mean is both by lowering the short rate, but also in the event that the long end became inconsistent with the underlying domestic economic conditions, the solution is obvious. You just print money and you buy the bonds. It's that easy. And so it doesn't mean they necessarily even have to print the money to buy the bonds, because since we all know that they're going to print money and buy the bonds, when I see the bond yield at 5%, I am pretty confident it's not going to go to 10%, because that would be incongruous with domestic economic conditions, and the Fed would respond to that well before we got to that point.
What's really interesting is, you've heard this narrative a lot recently, which is that, the Fed is sitting on their hands and doesn't want to do anything right now. But when you paint this, and one of the key reasons is because if they were to cut rates right now, the dollar would weaken. But what you're saying is that that's not really an issue. So then I start wondering is, why are they not rushing to cut right now? It's clear that growth is deteriorating. It's clear that there's a lot of negative growth impulses coming from the fiscal side of things, which is a very different situation than what Powell was dealing with in the last couple of years, where he was fighting tooth and nail against fiscal positive impulses. So yeah, why is he not, signaling to cut in May if this isn't an issue?
The Fed is very backward, is backward looking by definition in this environment. The data that they see is, they think the unemployment rate is 4.2, 4.3%. That's a pretty good unemployment rate. It's been pretty stable. It's not moving significantly. They see, inflation, core PCE prints have been a little high the last couple of months. If you were let's just say you looked at nothing else and you just looked at that set of information, you'd say, seems fine, right? Like, seems like there's no reason really to move rates. And on top of it, there's a fair amount of uncertainty in terms of how the tariffs, whether tariffs will happen or will persist or not, and how those will flow through to consumer prices in the same way. You might have a question if you had a big VAT hike. You might be a little hesitant to shift monetary policy till you see things flow through from that perspective as well. And so I think part of the story here, it's a little bit like people have some expectation that all of this is going to be instantaneous. Like, and it's not. Like, what's going to happen is the Fed, given what they see, won't do much. If the capital flows away and we essentially get bond yields to rise a little bit as a function of that, bond yields will be a little too high, equities will be a little too soft, growth will slow. The slowing of growth will then, once it gets weak enough, then the Fed will eventually respond and they will cut interest rates. And similarly, if we start to see growth weaken enough, we'll also see a bid on the long end. And so in some ways, it's almost like like anytime these bond moves happen, they're sort of self-defeating. I'm surprised people like draw straight lines like up and down in terms of bond yields, and don't like, if you just look at back in the last 5 years, like bond yield moves have been self-defeating, meaning like we went to 5% bond yields, and guess what happened? The economy slowed, asset prices fell, and then bond yields fell down and they went to 3.75, and they're like, well, that's too stimulative. And then they went back up. So they went back down.
There's no bad bonds. It's just bad prices for those bonds.
That's right. And I think that's an important thing when you're looking at the dynamic is bond moves in particular aren't self-reinforcing. They're not like stocks. Stock price moves are self-reinforcing. Bond moves are self-defeating. And that's because as the interest rates either rise or fall, they basically shift the economic conditions as well as the attractiveness of how the asset is viewed to then create, sowing the seeds of the reversal of the thing itself. And so I think that's probably what we're seeing. I mean, that's what we've seen in the last, couple of days or something like that, when we saw bond yields rise and then they were too high and then they came down, that's kind of what we've seen in terms of the bit.
Tokenization isn't just a buzzword. It's the most efficient way to reimagine how financial assets are owned, traded, and managed. Ondo is bringing traditional assets like stocks and bonds on-chain, unlocking trillions in value and creating open global financial markets. They're not just dreaming big, they're building the platforms, assets, and infrastructure to make it happen. Head to ondo.finance, ondo.finance, and see how they're bringing capital markets on-chain. Restrictions apply. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Yeah, absolutely. That's an interesting characterization to shift into as we look at, if we assume that these trends are going to continue, and obviously there's a lot of question marks around how durable these tariffs will be, but if we assume this trend will continue, thinking about how those foreign asset allocators are reacting to this. And I want to separate the question into, let's say like private pension fund managers and also, foreign reserve managers at central banks and how they're both thinking about that. But, obviously the two main asset classes are equities, which you're saying are highly reflexive, and then bonds, which are highly like self-correcting in its own right. How are you thinking about the impact of this continuation of trend on those two asset classes and how those two different types of people are reacting to this?
Well, I think part of what comes to mind is that we've had an extended period of time where stocks have meaningfully outperformed bonds, even like on a risk-adjusted basis, volatility-adjusted basis. where you'd expect essentially the mean return of stocks versus bonds to be on a risk match basis to basically be zero. Instead, stocks, depends on exactly how you think about it, on a risk match basis are up like 100% relative to bonds over the course of the post-COVID period. Okay, well, that's a radical pricing that's in there, which is basically a very high growth, positive growth pricing that's gotten into bonds, into stocks relative to bonds. And so what we're seeing is, and then you combine that from a foreign investor's perspective with the fact that the dollar, had gone basically back up to near all-time highs. And so from a foreigner's perspective, you basically have like stocks in dollars, stocks versus bonds in dollars at all-time highs by a mile. And so now what we're seeing is when the foreign investor is sitting there, they're starting to look at that. They're starting to say, well, this is actually probably not a good environment for stocks relative to bonds. We're starting to price out those extreme expectations because of the negative growth policies. And we're also seeing a world where, U.S. exceptionalism, sort of broadly defined from a growth perspective, is likely to moderate. There's some elements of, foreign efforts to stimulate their growth as well. And so you look at those two things, and that basically is just unwinding the trade, right? The challenge is all the unwinding we've done so far in that trade, which is, U.S. stocks versus bonds in dollar terms relative to foreign currencies. We've unwound basically the euphoria that got priced in post-election. We've unwound that, but we basically haven't unwound any of the last 5 years where this trade has been a huge one-directional trade. And so I think that's really the story when you look at it, is starting to go ahead and reprice that idea out because of the set of policies that, and the trends that are existing in the US. And that's the sort of thing that's the sort of trade that can exist in the same way it boomed for 5 years. It can, it can fizzle for 5 years. And that's sort of the path that it looks like we're on right now. It doesn't mean it won't change. Who knows? Policies may change, dynamics may change. But with this set of monetary and fiscal policies that we're seeing today, the idea that you're going to have essentially an extended underperformance on U.S. exceptionalism, particularly from a foreign investor's perspective, looks increasingly clear and has a long way to go.
So that sounds like a lot of the change so far has just been the higher frequency asset managers, basically, but we haven't seen that durable shift in flows from, like the reserve managers of these foreign central banks. So I'm curious, what are you starting to see in terms of what are they shifting towards? So once they get out of U.S. assets, are they putting it into their domestic, bonds? Are they putting it into their domestic equities? Are they putting it into gold? Gold's been on an absolute tear. Is it a combination of all three?
First of all, folks who are thinking about, like, let's say you're a pension fund manager in Germany and you're responsible for your stocks, like remember, you were off for Christmas, you have some thoughts, you have to have 6 meetings, now it's summer, you still haven't changed your asset allocation. Like, if anyone's dealt with, institutional investors, particularly institutional investors in Europe, like we're beginning a process that could take 5 to 10 years because of the time that it takes, the decision-making time that it takes. And so a lot of the moves, as you say, it's mostly been, a lot of ways, it's mostly like hedge funds front running what flows the big asset managers are going to do in response to what's going on, right? That's basically what's driven the market. It's not really, a significant shift in allocations that are happening. And so, and again, because it matters what the marginal dollar flow is, even if, the pension fund manager from Germany, if they were sitting there saying, look, instead of plowing 80% of my capital into Mag 7 stocks unhedged, let me just not do that. Let me hold it in the bank. Let me just buy a portfolio that reflects some home bias in terms of my strategic allocation. Let me just buy, honestly, a market cap weighted portfolio in many cases across developed economies. All of those things would lead to less capital flows without even having to meaningfully reverse a target position. And so I think we're very early in that reset, that in terms of the dynamic of repricing or slowing the capital flows in the U.S. And where does the money go? Well, I think in many cases, people don't necessarily have and this is a very US mindset, like it is not the natural state to be all in on US dollar assets and US stocks. Like, I know it's hard to believe. If you follow Twitter, you'd think that people only invest in Mag 7 assets and chase Tesla returns and stuff like that. It's like if you're a Australian pension fund or sovereign wealth fund, or you're a European pension fund or sovereign wealth fund, like your neutral, particularly currency state, is in euros, and in investing in domestic assets, having that meaningful home bias. And so, if anything, the behaviors have been very different of late. And so, just moving towards normal or even modest home bias, not even normal from a long-term perspective, but modest home bias would create a huge shift in flows out of U.S. assets and into the assets, the financial assets of in foreign jurisdictions, in a way that's not like some grand diversification out of the dollar, some giving up on the dollar as a reserve currency. It's merely like normalizing the asset portfolio that you're holding would create a huge change relative to the US getting 70 cents on every dollar.
This idea that it's actually more so just returning to normalcy is interesting, because what I've been wondering is, okay, if we woke up tomorrow and the trade war was completely reversed and we went back to where we were before Liberation Day, even before inauguration, honestly, I'm trying to figure out, is the genie out of the bottle already? Are these trends already set in stone, and these pension fund managers are still going to have their meetings in 6 months to rethink? And sort of feels like everybody's waking up from this weird days we were all in, where we're all just Mag 7 obsessed, and it was just the trigger was the tariffs. But if we took out the tariffs and that didn't happen, do you still think this trend is durable?
Probably is the answer. I think you see these throughout history. You see these sort of dynamics where everyone gets bulled up on something, then expectations get extreme, and capital's like pouring into whatever they're bulled up on, and then something happens, some disappointment happens, and that creates the reversal. Even honestly, even if the fundamentals aren't really changing, even if nothing is really all that much changed, it's just that you had very high expectations, those aren't quite met, and people start to move their capital away from those assets, and that takes, as you mentioned, like it just takes time. Like it's hard if you haven't engaged with a lot of institutional investors. It's hard to appreciate just how slow moving the shifts of the biggest capital is in the world, right? Because it just takes time to figure out what you're going to do and then slowly allocate towards the thing that you're going to do. I think in the same way, when you look at things like reserve asset managers, which, are they giving up on the dollar? Like, no, they're not giving up on the dollar. Like anyone who says that they're giving up on the dollar, that is malarkey. That is false, right? Are they gradually looking for other places to put their capital? Yes. Is gold getting a big beneficiary from that? Is a big beneficiary of that? For sure. But these are glacial moves that are among big capital allocations. Glacially moving can have significant effects on financial asset prices for an extended period of time.
Okay, so I want to shift into understanding how you're thinking about the economy as it stands today based on everything that's happened so far. So as of right now, we have the soft data is falling apart. The survey data is a mess. The hard data has been pretty resilient. It's even been ticking upwards because of a lot of tariff front running. We have the GDP print tomorrow. That is, who the hell knows where it's going to be. We have the Atlanta Fed that is at like -2. We have New York Fed at +2. I don't even know. And then you have what's going on in terms of what's coming down the pike in terms of just the lack of container ships and just goods coming from China. That's looking like that's going to be the next big, shoe to drop here in terms of the economy. So based on all of that, like, how are you thinking about the economy right now?
I think one of the questions is how long does it take for what is essentially a supply shock from an embargo, which is essentially what we have in the US at this point, particularly for Chinese products. How long does that supply shock take to feed into the real economy? And how magnified is that supply shock in the real economy? I think, and in many ways, I think people are I think we're all sort of struggling to figure that question out. Now, I think from a consumer's perspective, at some level, it's pretty simple, which is prices are probably going to go up. If I'm going to buy something, particularly a larger ticket item, I should probably buy it now, not in the future, whether it be a car, a television, other electronic equipment, furnishings, all of that stuff. And so there's sort of a normal response that we're seeing. Like if you went back and studied like the Japanese VAT tax increase, now we're getting real nerdy on this stuff. What you saw was basically a big surge in consumption in the 3 months before the VAT tax increase happened. And if you looked at, if you were blind and you're just like, I'm just looking at that, you'd say, wow, the economy's booming. And then of course the VAT tax increase happens and demand slows subsequent to that because people had front run all the demand. And so I think we're seeing essentially that dynamic happen, which is the data looks strong, good, fine, if anything, a little bit stronger because there's so much demand. Just look at like, new vehicle sales, right, is the highest it's been in decades in March, and probably even higher in April because people are front running, or other retail sales. So it looks kind of strong right now because people are front running it because we're going to see, the tariffs flow through, or the embargo is the better way to describe it, the embargo to flow through. And then most likely we're going to see price rises like I wrote about today, which is, we're starting to see price rises, whether it's in autos or consumer goods, et cetera, as a function of the tariff rises. And so then that'll happen and people's real demand will slow as a function of that. I think the real question is just how disruptive this is. Like people, smart people have suggested that, this could be on par with the COVID disruptions. It could be worse than the COVID disruptions, as a function of just all the different places where, the Chinese the imports from China are critical inputs into all sorts of different products, way more important than my baby soap that I'm worried about.
Okay, so for the last part of this conversation here, just want to shift into understanding everything we talked about. For me, characterizes this idea that what has worked for the last 20 years is probably not going to work from here on out. And want to take that idea and showcase it in terms of portfolio composition and how to start thinking about it in terms of, obviously we have to start thinking outside of just the US now. We have to start thinking about other countries, most likely. You've also launched a new ETF this month, I know, in terms of focusing on global macro. So just bringing in unique, correlations away from beta. So putting that whole piece together, what's the right way to think about portfolio composition right now?
First of all, it's really important always to just separate your tactical alpha views and the alpha views of others from what your strategic savings portfolio is. And you've probably been bored to tears by this, if you had Andy on and other Bridgewater alums that emphasize this concept. But I will say it anyway because it's important. And I think what this highlights is like, look, everyone in the world is overweight U.S. assets relative to what a reasonable diversified portfolio would be. They're overweight stocks relative to things like bonds and gold, and they're overweight U.S. assets, and particularly U.S. stocks relative to global assets. And if, we've mostly just started what could be an extended period of reversal of capital flows into U.S. exceptionalism. And like now is the time to think about what is real diversification in your long-term savings portfolio. And that means holding a global basket of equities. It means including bonds. Bonds are, given the conversation that we just had, U.S. bonds should be expected to maintain correlation benefits, diversification benefits relative to stocks. You might think about tips, which are, still offering a relatively compelling real return. And then really thinking about, what is your currency exposure, both in terms of, whether you have a diversified developed world exchange rate exposure, but also thinking about the value of gold in terms of a diversification tool in a portfolio. All of those things they're all just different ways to make sure that you're actually diversified. Like people have been penalized for diversification for the last 15 years. If the next 15 years are going to look different than the last 15 years, then you're going to be benefited from diversification. And now's the time to start thinking about that. On the tactical alpha side, I think there's basically two ways that you can approach this. One, you can make the bets yourself, listening to smart people who have views. And I think there's a lot of different ways to do that. I put out this wrecking ball portfolio, which is, kind of like, what's the combination of different positions? It's a combination of being long bonds relative to stocks, long foreign stocks relative to U.S. stocks, long gold and short the dollar. It's kind of a combo portfolio. You don't exactly know how this dynamic is going to play out and where exactly it's going to get, be greater priced or less priced. And so it's a way to sort of bet on the theme without being too concentrated in one particular bet. That's, and people can see that on Twitter. I got threads on that. The other option, which I think is a really compelling option, is you can hire people who are smart and do this for a living to basically generate alpha in your portfolio, so you don't have to do it yourself. And take it from people who do this for a living. Generating alpha is pretty hard. It's no part-time job, I'll say that. And so, as you mentioned, we've been working for a long time to sort of bring hedge fund strategies to every investor, and most recently have brought a new ETF to the market, which is HFGM, which is a global macro strategy. So we use technology to understand the positioning of all of the global macro managers that are out there in close to real time, and we take that understanding and those views and package it into an ETF, and that way essentially you can what I say is invest like the best in terms of those managers. And of course, unlike investing in traditional hedge funds, the ETF structure affords a much lower price point, more tax efficient, as well as a much more diversified, much more manager diversified, effective exposure. So that's what we're doing, and that's the sort of thing that if you don't want to do this on your own and you don't want to manage the portfolio on your own, and man, it's tough.
Yes, it is.
You might find that just making a strategic allocation to that product or a diversified set of alpha products could be beneficial for your portfolio.
Yeah, awesome. Well said, Bob. Well, always good to get you on the show. Really love the way you just laid that whole thesis out. I think it'll be very helpful for people to understand some of these big shifts that are happening, because it is a very interesting time. So thank you, Bob.
Thanks so much for having me. It was a great time.
Yeah, likewise.